Hello everyone and a very warm welcome to our viewers. Today we will discuss compliance requirements for foreign entities having income from India. Let me give you a brief background. India has numerous Double Taxation Avoidance Agreements (DTAAs) with various countries to prevent double taxation and to promote international trade. Generally, withholding tax rates for royalties, interest, dividends and technical services as per Indian treaties range from 10% to 15%, whereas the highest effective tax rate under Indian domestic law is 21.84%. To access the lower tax treaty rates, foreign entities must qualify as residences of one of the two contracting countries. This video captures documentation requirements for non-residents to enable tax deductors to apply the lower treaty rates at the time of remittances abroad. Form 10F is required when the Tax Residency Certificate (TRC) lacks specific details like full address, legal status or tax residency period. This form is submitted along with the TRC issued by the taxpayer's home country tax office. Additionally, a no-PE certificate is also required to confirm that foreign entities do not have a permanent establishment in India. Form 10F is a self-declaration that non-resident taxpayers must file to claim benefits under a tax treaty. It supplements the TRC when details required by the income tax law are missing. Form 10F needs to be obtained every financial year in India, from 1st of April to 31st of March. It must now be filed electronically. The facility to obtain the online Form 10F is available from financial year 21 to 22 onwards. The window to generate Form 10F for the present financial year 25 to 26 is now open and can be submitted. In our recent experience, where Form 10F was not filed electronically, treaty benefits were denied during ITR processing and income was assessed at higher tax rates. Let me explain with an example. Suppose a foreign company has an income of 10 million euros from Indian customers. The company filed its tax return in India, declaring a tax amount of 1 million euros at the 10% rate prescribed by the treaty. However, the tax department applied the higher domestic tax rate of 20%, plus surcharge and cess, resulting in a final tax assessment of over 2.2 million euros, leading to an additional tax liability of over 1 million euros. The issue was resolved upon filing Form 10F and rectification applications. To wrap up, Form 10F is more than just a form. It's now a critical piece for smooth cross-border payments and claiming DTAA benefits in India. Before we close the video, let me remind our viewers that while obtaining a TRC and submitting Form 10F are necessary steps, they do not automatically guarantee treaty benefits. It is crucial to assess the factual situation thoroughly. First, constitution of the entity. The legal structure and nature of the foreign entity must align with the treaty provisions. Secondly, residence of partners. For tax-transparent partnership firms such as the co-KGs or pass-through entities like the US LLCs, the resident status of the partners or shareholders is critical. Thirdly, principal purpose test or PPT anti-avoidance rules. The principal purpose of the arrangement should not be to obtain tax benefits. By carefully evaluating these factors, foreign entities can better position themselves to legitimately claim treaty benefits and avoid potential disputes with tax authorities. In the words of a senior advocate in an ongoing case at the Supreme Court, the TRC is not a magic wand. If your company needs assistance in analyzing any of these issues or tax filings, our team at Rödl & Partner is here to help. You can find our contact details in the bio of this video. Stay updated, stay compliant, and thank you for watching.